Karthik Reddy, welcome back to ET Ask the Expert. First question for you. We're heading into an actual the seasonal winter, but has the funding winter ended?
Suresh, once again, thanks for having me. It's a pleasure. Love to talk to your audiences. I wish I had a better answer, but I think the thaw is very, very, very slow. I think the corrections are happening. I think the memo has been received by everyone that funding is not going to come and rescue you. If the fundamentals are going to come and rescue you. So you can see a slew of companies going public, they're turning profitable, they're ratcheting down their valuation. What was thought unthinkable is companies actually taking down rounds to go public. So I think the reality is that this one-way street of valuations and this hunger for going and raising more capital that had hit hard, but I think the corrections are almost complete. I think we're maybe still about 6 to 12 months away from all of it kind of getting cleansed up, primarily because there was so much capital and the smart founders who could survive for much longer were doing that all this while. But inevitably, that capital either runs out or the investors' patience runs out, and you have to find an end outcome. And is that an M&A? Is that a down round? Is that a IPO? That's what boards have been racking their heads around for the last 12 to 18 months. Are all of them out of the woods? Not yet. So I wish I had a better answer, but I think we are still a year away.
I think the line that you said about funding won't rescue you, but fundamentals will. I think that's a pretty cool line for startup founders to remember. Karthik, you're a venture capitalist yourself, and many people in our audience and out there in the world think that VCs are these fundamentally phenomenally wealthy people, the Musks and the Bezoses of the world, and that you're using your personal money to fund other people's businesses. Is this true? Are you a phenomenally wealthy person?
Couldn't be further from the truth. The audience wouldn't believe that this wasn't a plug question. I don't know if you know this, Suresh. We last year, I don't know when we did the last Ask the Expert, but between then and now, I think we've released two versions of what Blume codenamed the Omega files. So basically, it's like a tell-all, like how fundamentally a VC firm works. So for youngsters who are listening into the show, who really want to understand how a small VC fund works, I think this is a good ready reckoner just to understand what we went through in 2011. So most people will say, "Oh, the world has changed. It's 2024. The funds are bigger. They're richer. There are more funds." The reality is, if you raise a 15, $20 million fund, the math doesn't change dramatically. So I did something crazy this time, which when the team didn't know till 12 hours before the release. I slipped some data into them, which actually was my income as per my tax returns for the first 10 years of Bloom. so, so actually, you can see my income curve, and unless I'm evading taxes or something, that's the reality of a micro VC. Micro VC is tough. Early stage VC is tough. Some of us might be privileged from have made money through startup exits or other exits. Unfortunately, by the way, since we're doing this for the Times, I should also disclose that was my last pay slip. I worked, my last day job was the Times Group, actually. I didn't have enough money stashed away. I was a paid employee. And it's a very tough journey when you start off. Now, somewhere along the 10, 15-year mark, if you've actually done good investing, you start seeing your profit shares, or what's called carry in our business, which is basically, it's an American term, but basically it's share of profits that we make for our investors. So because you have to wait 8, 10 years to know whether you're really good at this or not, the industry broadly is rewarded with this idea of, share of profits. When the share of profits kick in, they are the ones that really sort of get you to be a little bit more wealthy than when you started off 10 years ago. Now, there's this joke that in very large funds, like the $1 billion funds, if you're earning 2% fees, that's $20 million a year to run the firm. You don't need that much money. So VCs can get a little bit rich on just the fees. But if you're running a $100 million fund, then you're running an entire organization with that same 2%, which is $2 million. So it's not like the organizations are incredibly intelligent if you're much larger as a fund. Can't be 10 times more intelligent, right? But you get 10 times more of a budget to run the organization. So some VCs do get a little rich on the fees. But the real money is in the profit share at the end. And here's the final rub, in a good way. People who give us the money, who are called LPs, limited partners, these are the folks who insist that we want your money where your mouth is. So if you have money, You should actually be investing it into the fund, because you can't take $100 million from us and have 5-10 million stashed away elsewhere, not be contributing it to the fund. You should be putting a substantial part of your savings as well into what you're asking us to invest in. So it's called GP contribution. So to that extent, we are investing. If at all we've made hard-earned money, it's being invested back into the fund. Uh, there's no way the top 10% of VCs can be remotely as rich as the top 10% of entrepreneurs. The difference is, though, the VCs are taking blended risk across an averaging of assets. So if an entrepreneur fails, they've lost everything. They've not made much money over an 8-10 year period. Whereas the VC has a hedge. He's lost his money in that bet, but he's made some money elsewhere. So we get like a democratized average return across many assets, but we can never make as much as a staff entrepreneur is, and we shouldn't as well. They're taking the big risk. They're taking really bold bets, and they're building multi-billion-dollar businesses. So that's the division, I think, between VCs and entrepreneurs.
So, Karthik, we keep hearing this urban legend that for every 10 bets or 10 investments that VCs make, about four or five of them are bound to languish. Two or three of them will be moderately successful, but only one or two will be blockbuster hits.
Yeah,
Is that
it's
true? Two
true.
out of 10?
It's true. I wake up every morning hoping that I can prove that formula wrong. But the reality is 30, 40 years of venture history. This is, by the way, let me caveat for if you're truly students of venture, this is a venture capital paradigm. It's very different in private equity. In private equity, almost everybody aims to at least get capital back on every investment. They hate losing capital, right? The venture capital paradigm is because you're taking so many unknown risks, right? It's almost the industry existed to take risks that nobody else would. New business models, new technology, new tech that might fail because of patents, regulations, tech changes that come from the next generation. AI would have killed hundreds of SaaS startups, et cetera, et cetera. So you don't know what risks you're taking compared to, let's say, traditional businesses. So this ratio of losses, moderate wins, big wins, A is true. And more importantly, if you look at the way the capital market is structured, the risk takers are lesser, and they'd rather put more money into the leaders of every part of the funnel. So suppose 5 companies started taking similar risk. Only 3 make it to Series A, only 2 make it to Series B, and only 1 or 2 companies like that could get public. So it's a nature of the market. There will be M&A along the way, there'll be failures along the way. And so 1 or 2 become these blockbuster hits. So everybody now shifts gears and says, forget about every company trying to do well. Let's play for those 1 or 2 blockbusters. So the entire venture model sort of reinvents, or rather recalibrates, to play into the power law, as it's called in the venture business. So yes, it is not just a myth or a legend. All empirical evidence from the past proves that that is the way to play venture capital.
Now, who are these LPs or limited partners? Are they some extremely anonymous, shadowy millionaires behind?
No, they don't like to be in the public limelight, but they're not shadowy folks. It's actually places where some of our kids and friends and etc. go study at, or where it's Canadian pensioners, it's American pensioners, it's our tax money coming through the government of India, for example. So broadly, that there is a consistent theme, though. LPs are people, especially in the asset class called venture capital or private equity. The allocators are typically people who have incredibly long-term horizons for their money. They're not thinking of benchmarking this to what are stocks and bonds doing over the next 2-3 years. They're thinking about what would this mean in terms of outcomes if I was stayed invested for 20, 30 years in this asset class or in this manager. And therefore, my favorite tagline around this is I call them infinite horizons, pools of money which have infinite horizons, which means they don't think about a end date or a end timeline on their capital. They're basically predominantly custodians of capital, meaning they're university endowments, family or healthcare or not-for-profit endowments. For example, not to expose them, but if you go to the museums or the libraries of New York, they actually have a few $1 billion in endowments. And they're investors. They're investors in venture funds, pension funds, sovereign funds, because whether it's Norway or Abu Dhabi or Singapore or Canada, they actually have to invest outside of their country as well to de-risk and get higher returns for their country. So it's sovereigns. And then the new shinier sort of class of late has been family offices. So family wealth, especially for the, let's say, top 1% of the world, has grown in such massive quantums that you can't simply uh, invest the way we used to in the 90s, put some money in fixed deposits, some in gold, and some in. It's just too large a quantum of money. And so more and more family offices are hiring professionals just as universities and pension funds would hire, and then actually have them allocate in a very similar fashion. So the difference being they're not answerable to a board of trustees, etc. They're usually answerable to the family member who made most of the money. And so they tend to go with their risk appetite. But over a generation or two, they will all evolve because of the people they hire coming from such organizations to look very much like a college endowment. So there are, believe it or not, like the Bloomberg family office, the Chanel family offices run into tens of billions of dollars. So they're run by professionals, no family members coming in micromanaging what gets invested. So a small allocation of that, I mean, for all of what I said, all of private equity and venture is somewhere between 5 and 12, 15% of their allocations. And that gets divided across literally dozens and dozens of managers like us. Since you asked, and it's contextual to India, the way people allocate is how much risk do I want in venture capital? Within that, is India a market worth playing? So somebody might say, I'll play India, but I'll play public and private equity, but I won't play venture capital. Somebody might say, I won't even play venture capital, right? And then you stand in line and you want to be counted amongst the best to get allocations. So sadly, if you want to get institutional in your avatar as a venture capitalist, these are the pools of capital that will get you to 100, 200, $300 million fund sizes. Otherwise, like we started, we'll be a micro VC. We'll go door to door, get 1, 2 crore commitments and raise a $20 million fund, which is how we got started, by the way. I'm very grateful to the people who helped set us up. But if I go to the same set of people and try to raise what I did, which is a $250+ million fund, there's no way it's going to happen. So we all evolve.
Okay, I noticed you addressed youngsters in your first answer. I'm no youngster myself, but Karthik, if I wanted to come and work at Bloom, how do I train to be a venture capitalist?
Yeah, this is one cottage industry where there are no perfect answers. So I think there are two, three options maybe I would suggest. If you work in, let's say, private equity, investment banking, out of campus, you get these kind of jobs, or wealth management, you broadly get exposure to the fundamentals of finance. So that's an option that you go and put in those 2, 3 years, and then you know passionately pursue the literature around venture capital from the outside, and then make a case for it. I tried that and I failed. When I came back to India in 2006, people said, "Hey, you seem to have a decent resume, but you haven't done anything in venture and you're coming back from the US. How are you relevant for Indian venture capital?" So I won't name all my peers who dinged me at that point, but nobody hired me, right? Not that that's the reason I went to the Times Group. They were a great employer, but broadly, venture didn't hire me because it was even smaller as an industry. There were literally 10 firms. There were literally 100 people who were partners or one level below. That was it. That was the ecosystem I came back to in 2006. Today, I would say that number has grown to 1,000 or maybe 1,200 or 1,500. Not much more than that. It's not like there are 10,000 professionals. So therefore, it's very difficult to break into and get noticed, right? So one shot is that what you have is from campus, but none of us hire at campus. So then you try to break into startup land because essentially, especially if you're doing early stage, or for that matter, even late stage venture, what are we backing? We're fundamentally backing how we think a certain entrepreneur or a certain company can become that blockbuster hit. So, what is a venture capitalist looking for? Somebody who understands that in the first person, having worked in such companies. So, can we go and get that talent which is experienced working alongside a CEO founder of a startup? So, founders' offices, strategy roles, in all the way from Flipkart down to like a Series A startup are all valuable experiences. What's emerging as a third track, which is very interesting, is to show your entrepreneurial nature. I think even though venture capital is not a job in my view, it's a very sort of entrepreneurial bent of mind. Nobody's going to babysit you and handhold you into going and winning deals there. You have to walk into a cafe, literally hit up the entrepreneurs, convince them to work with you, build a reputation, get the bets right, along with your colleagues vouching for that bet, and then your legend grows and your reputation grows. So it's very entrepreneurial, right? And so what we have seen is a generation of folks who start writing, start podcasting, who start commenting, who would have probably I nowadays I see folks who come for interviews. If I've done 10 or 12 or 15 podcasts over the last decade, they probably heard half of them, right? So they're doing the work. They're understanding what the craft means. What does venture capital mean? They're trying to learn it. They're constantly following it. They're on Twitter and they're LinkedIn, sort of calibrating themselves to the knowledge that's out there. And then the best of them are actually becoming podcasters. They're becoming community writers and they're building their reputation. And then it's much easier to get hired because somebody says, hey, this is that kid who wrote a great set of blogs around this industry. So that's a new breed we are seeing. But I wish there was something more formulaic. Since it's such a boutique industry, you really want to know that you want to commit to something like this for multiple decades. There's no short-term rewards. I mean, it's like you can get an experience over 2, 3 years, but that's not going to give you any rewards. It's just like any other job. What is thrilling and rewarding here is to watch 10-year, 15-year journeys of startups unfold, which means if you want to see 3, 4 cycles of that, you're going to end up spending 25, 30 years. You've got to be really, really sure that you want to do this.
So, Karthik, you have invested, by you, I mean, as an agent of Blume, have invested in education, an academy, beauty in purple, and pixel in space tech. Now, how can any one human being understand education, beauty, and space tech? How is it possible?
No, it's a good question. I think what you understand are slowly and gradually the fundamentals of things like business models, founder DNA that builds a great company, um, their ability to team build, um, capital markets, who's going to fund these companies after you, etc. So these are common ingredients, irrespective of sector, irrespective of how boring one company might look like and how sexy another might. If you ask me or Sanjay when we started the firm, we were guilty of trying our hand at everything. So if you're running a very small firm, you tend to try and be an expert of everything and master at none, right? You'll fail at it. So by around 2016-17, which is about the halfway part of our journey so far, we realized that we can't compete with this generalist attitude, right? And in fact, a lot of the firms that have been born after that, Suresh, are interestingly sector specialized
Focused
firms.
on one.
Yeah,
Okay.
they're just focused on one thing. Because for exactly what you said, it's difficult as the ecosystem matures for a individual to be doing everything. Now, when you ask how come Bloom does all this as a firm, here's the secret. We've talked about it quite openly, but the secret is essentially we grew into a 5 partner firm from the original 2 partners. And as we were growing into that in 2017-18, we forced partners to choose what sectors they want to become experts at and specialize in that and commit to that for the next few decades. You can't switch every 3 years or 4 years. You can add a new sector that's emerging. Somebody could put up their hand and say, crypto and blockchain is a new technology, it's a new sector. I'm going to go and do like deep reading, deep thinking over 6 months and come back and claim it as I'm the best expert in the space. Full marks to you. But if you say that I have not done consumer brands, my colleague has done consumer brands for 8 years, and I'm going to get better than them,
Yeah, that's
tough. Yeah, that's
fair
tough.
enough.
Yeah, tough luck if you're going to try and beat them. So that division has happened, and basically we are divided into deep tech, climate in one pod, fintech in another, SaaS software, AI in another, and then all of consumer SMB in another. And essentially now when we hire in Bloom, now we don't hire generalists. We can only hire if you fit into one of those, and the gap is in those. So somebody incredibly smart, but a generalist might come and say, "I want to join Bloom," and sadly, the opening might be in deep tech, and they might love consumer or fintech. Sadly, there's no roles for them, right? And believe it or not, the entire industry slowly begins to organize itself around the same principles. So there are very very few generalists left in the industry.
So, Karthik, I imagine you listen to a lot of pitches, or at least used to listen to a lot of pitches yourself.
That's right.
So do you know a specific point during a pitch where you get hooked, and a specific point where you said, "Okay, I'm logging off. I'm mentally out of this."
So we've tried to solve that problem by forcing, and a lot of founders are surprised by this forcing function. We actually limit our first meetings now to Zoom. It started pre-pandemic. We thought we were geniuses because we were covering the entire country and we didn't need to physically meet founders. Then the pandemic actually made everybody start doing that. So everyone is doing Zoom pitches. And now we actually think it's that riyaz or that rigor, which the founder doesn't understand because they're used to different formats of pitching. But from a Bloom perspective, you're only given 20, 25 minutes to pitch. So one is you hope that the biases don't are not too short, not too long. So if you spend an hour, you start developing different type of biases. If you spend 5 minutes, you spend different type of biases. So our mix is about 20, 25 minutes is enough usually to judge. So what we're doing essentially, Suresh, is depends on each of our styles. But fundamentally, to your point, I'm looking for in the first part, I'm not looking for the explanation of the pitch deck. In fact, we insist that you can't get on. So firstly, we think the meeting format is carbon neutral, so it's very effective. The timing allows for if I have to push it to somebody else in the firm, is suddenly two people in the firm have spent only half the time each, and the founder has spent a full hour, but like has got multiple perspectives set up in the firm. So we think that's a clever way to de-risk our biases. So just in case I didn't like it, but my colleague liked it, then at least we can have a sparring match and not me rule something out simply because of my biases. The second is we insist that the deck comes as a pre-read, so you can quickly browse through it. And this is goes back to what a Rahman would do with music, or what a Djokovic would do with a tennis racket. You see the pitch, and you broadly know the flow, the kind of questions you want to ask, what you want to pin down on. And it boils down to the same framework. It's not any different from most VC firms. It's fundamentally, do I like the market? Do I like the market? Not whether the founder likes the market. So, do I have a view on the market opportunity, the size? Do I like it? That is a must. Do I love the founders, the team, the build out? Are they thoughtful? Are they complementary skills? Does it look like? And the toughest part to judge is, does this founder evolve from 1x to 10x to 100x? Because fundamentally, I'm only playing for the 100x, but I'm judging them at 1x, right? And occasionally you'll find a second time founder who's built to 5x or 10x. So a little easier because they have proof points on their scalability requirement being a little lesser than somebody who starts as a first time founder at 1x. So we're trying to judge these two, three elements very quickly. And then the final thing is how the founder can sell you whatever market opportunity. If you don't believe it, you should do it. And if the founder is able to sell you a great market opportunity, the question is, do you believe that however they're approaching the problem is truly differentiated? Or are 10 guys like him or her going to get funded in the next 12 months, which means you're in a rat race to try and win some momentum or FOMO race that all the VCs are going to chase. So we truly try to look for, is there differentiation? Is there great founder capability to scale? And is it a market we love? And finally, I think bringing it all together, what we're looking for is, you know, why is this founder chasing this problem, right? And somewhere in the first 10 minutes, you get a flavor for that. So to your point, I think 20 minutes is for, as I said, going double clicking, but you should be able to gauge this in the first 8 to 10 minutes, whether it warrants a second conversation or not. And then you try not to make decisions too hastily, but you broadly get the picture.
All right, Karthik, moving on. Let's assume I made a pitch to you. I was successful in my 25 minutes. I got another meeting. I even got the money. I've taken the money from you. I'm running the business. I understand my financial and fiduciary obligations to a VC. What are my moral obligations to you?
I mean, to be philosophical about it, it's to give it your best, I would say, right? And to ask for help when you need help, and to be transparent and to be honest with your investors. All tough asks, because you have to establish such a relationship on both sides. It's very difficult to go down the idea of morality when fiduciary is being taken care of, because fundamentally the world understands investor entrepreneur investor management as a fiduciary responsibility alone. I think we take pride and joy in building relationships with founders where we think this moral layer kicks in, without imposing it. So you can't impose a model there because fundamentally the guy is going to say, "Hey, I took your money, right? I'll make you money." No, that's what I said. That's what exactly why I started with what I did. I think honesty, transparency, uh, giving it your best, right? And fundamentally, when they're afraid, they should not be afraid to disclose and talk. So I find it very funny when founders disappear for like, you know, a month or two because they're going through something, right? They don't want to come and report every day like they are to a parent, etc. But I feel like that is a little bit of a failure of that moral responsibility, for example, right? It's not about, oh, there is a rigor of a board meeting. All that is not early stage investing. That's late stage investing, where you have a quarterly rigor and everybody abides by it. You don't never build that kind of a relationship with the founder where they'll open up everything. Whereas in early stage, you're actually the first investor a lot of the time. So I think you're entitled, without spelling it out, to have a sort of a model contract that they're super, super transparent with you, and they bring all their challenges to you. You don't judge them for that, which is why they keep coming back to you, by the way. If you judge them for it, they stop coming to you. And if that contract can be somewhat implicitly held by both, I think it makes for a beautiful relationship. And fundamentally, as you said, a lot of things will fail. You said 4 or 5 fail, they do fail. At the end of it, can you feel that the entrepreneur gave it their best collectively as a team, and the circumstances or their best wasn't good enough, and therefore you have to write down your investment? It's incredibly painful to see those years of effort, those hours of interaction, millions of dollars go down the tube. So you have to have a balm to soothe that, and that comes from how this model contract was upheld during that journey, if you ask me. There's no other way to sort of soothe that pain of losing anything after putting in years of watching it happen.
And if I raise money, not from you, from some other VC, and I didn't like the VC, I didn't like the person, I didn't like the firm, can I give you your money back and ask for my stake back?
Very rare, very rare. I mean, for that you'll have to theoretically have um, the capital intact, right? Which is very rare. I haven't seen it happen yet in my life. It could happen after 6, 8, 10 years. And I don't think, unless there was something calamitously wrong in the starting of the relationship, it's very difficult for the investor to also go to his team, his investment committee, and say, "Oh, we made a mistake, and the guy doesn't like me, so he's saying he'll give the money back. We should accept it." What does happen very, very rarely is, Suresh, a company struggles to reach where you thought it would, like a Series A or a B. We've had that situation. But the founder basically said it's not going to get to that venture fundable stage. That said, it can sustain itself as a lifestyle business. I have service revenue, which can make enough money to keep me and my team going. But you guys are just sitting here as baggage with 30% of the company, right? What if you gave me 3 crores, and this is a true life story. You gave me 3 crores over 2 rounds. What if I return a crore or crore point five to you guys? Can I just take my stake back? And that's a very different reason
That's
why
it.
it happened.
The
But I'm giving
circumstance.
you a practical way that this could happen. Not because I didn't like your face, etc. I mean, then either party, one of the parties didn't diligence the other properly, or to your point, they were being morally corrupt in the original decision, right? So that's not the way either party should act. So it's very rare. At least, thankfully, we haven't seen anything like that.
Karthik Reddy of Blume Ventures, thank you very much for once again talking to ET Ask the Expert. Thank you.
Thanks, Suresh, for having me.